Hello everyone, welcome back to Module 7. In this module, we will go over Chapter 14 and we'll start to talk about more concepts on the supplier side. So please make sure you read the Chapter 14 of Mankiw textbook. I used the version 10th edition. So Module 7 is almost last for 2 weeks. I intendedly make this module a little longer because I know some of you might still want to spend more time in your midterm or the project. I have extended the deadline for that assignment as well. Please check your email or check your BBLearn for those new deadlines. So from this module to the end of the semester, we will be focusing on the firm's behavior and the market structure. Okay, let's get started. In Chapter 14, we're going to over many terms, definitions of variables that we're going to be using for making some decisions, for making some production decisions on the firm's side. So these terms are like, what is the total revenue, total cost, profit. We'll talk about how to calculate economic profit and accounting profit. And we'll also divide all the total costs sometimes into explicit cost and implicit cost. Sometimes we divide them into fixed cost and variable cost. And also, we'll be calculating what is total product, average product, and marginal product. And we'll be learning about the concept of a diminishing marginal product. In this chapter, we'll be drawing a lot of graphs again. With the given data, we can depict like average total cost, average variable cost, average fixed cost, and marginal cost curves, and we'll study the shape of each cost curve, and also the relationship between the different cost curves. Okay, at the end of the chapter, we will be introducing the different short-run and long-run average total cost curve, or ATC curves. And we will learn about the concepts of economies of scale and constant returns to scale or diseconomies of scale. So to begin with, we need to set the stage of this whole chapter that in economics, in microeconomics, we always assume that the primary goal of each firm is to maximize its profit. So this is the fundamental assumption we always need to make before we start to learn about the behaviors of firms. All right, now that we set this goal, right, to maximize the profit, then we need to carefully define what is profit. So profit, we write it as the difference between the total revenue, all the money you make, and total cost, all the money you have to pay to buy your inputs. So there are different ways to calculate total cost, right? Whether we classify cost items into explicit costs and implicit costs, or more often, we look at the fixed cost and the variable cost. And total cost is the sum later on. Oops, I just fixed the typo. So in this way, that we define a profit is actually called an accounting profit, because we're just subtracting the money outlays, right, from the money we received, right, by selling product. And we'll elaborate on what is an accounting profit in later slide. Okay? So now, next, we're going to recall a concept we talked about at the very beginning of the semester in Chapter 1, the opportunity cost. If you remember, opportunity cost is defined as the cost of everything you have to give up to gain to get something. And opportunity cost is very important in decision making, especially in this context, right? We are economists and we're trying to make the best decision for the firms. So the general term costs, right, when we are talking outside of economics, are actually what we define as explicit costs here, right? So those costs to purchase inputs will require an outlay of money by the firm. And implicit costs just literally means, right, the part of cost that do not require an outlay of money from the firm. So it's sometimes, right, hard to detect, sometimes being overlooked, but is very important in the decision making of production. So for example, when the owners of a firm, right, they invest money in the production or operation, there is actually an opportunity cost of those investment, those money that's, right, put in the firm. And at least you can consider, right, if, say, the owners, they invest those money in the financial market, they can earn interest, they can earn high return, even though there's probably, right, high risks as well, but they could at least earn interest by putting money in their saving account. But there is for sure an opportunity cost of those money, right, if that's being used otherwise in the financial market or just invest in a different firm. So we cannot ignore that part of cost. Is, right, in plain words, is the money that you could have earned, but you couldn't because you invested in the firm, right? So in that sense, the cost of capital is an opportunity cost, is an implicit cost, and it's relevant, right, when the firm is trying to choose between different, say, investment options. Make sense? So now that we define the costs in different ways, right, therefore we would have different measures of profit from there. And we define the accounting profit, right, as simply the difference between total revenue and explicit cost, right, the outflow of money that we paid to purchase inputs. And we also define an economic profit, which is, right, from the revenue we subtract not just, right, the monetary payments. We also need to subtract the implicit costs, right, such as the interest that our money investment could have earned. So in that sense, economic profit, right, will be smaller than the accounting profit because we're subtracting extra terms from the total revenue, right? In that sense, when you're comparing different options or different, say, future development plans, the economic profit is more relevant. It's the real difference across different options. It's the real profit, the real benefit, right, that is comparable across different options. All right, moving on, we're going to derive our production function and our total cost curve. So this is a worksheet that is given to us with some information of the production and cost structure of an example from the textbook, Chloe's Cookie Factory. So first term, list the number of workers. So going down, we are increasing. We're hiring more and more workers, right? And the second term is the output. So if you have taken macro economics, right, we call output production or the equilibrium quantity kind of interchangeably. So output is basically how much an economy or a factory produced, right? It's the quantity. The third column is the marginal product of labor. If you recall, at the beginning, right, in chapter 1, we talk about what is marginal. Marginal means additional. So marginal product of labor is actually how much product, how much output, how much additional output we get from one additional worker. So it's the difference, right, between the one worker output and the zero worker output. When we hire nobody, right, there's no output. We cannot calculate the marginal product of labor. And if we hire one worker, so comparing to the case when we used to have no one, right, the output increased from 0 to 50. So the additional increase in output brought by one more worker is 50. It's 50 minus 0, right? And similarly, if we hire one more, right, instead of one now we hire 2 people to work for us, to work for Chloe's cookie factory. And now that the output increased from 50 to 90. So the marginal product of labor would be how much additional output that this second worker brought to Chloe's cookie factory. The answer is 90 minus 50 and is 40. So similarly, you can pause here and feel free to verify, right, if 30 is the difference between 120 and 90 for sure. So that's how we calculate this column 3 based on information of column 1 and 2. And column 4, 5, and 6 give us some information on the cost structure of Chloe's cookie factory. The column 4 is actually cost of factory, or a better way to call it is a fixed cost column. Because obviously over time, this doesn't change, right? The cost of this column doesn't change. Let's just call it fixed cost. So it's like to operate this factory, whether you hire 100 workers or 0, you still have to pay $30. So maybe that's the rent for the machine or stand, something. You can just imagine. And column 5 is actually what we considered as variable cost, right? It's the cost of workers, but it changes when the number of workers being hired changes, right? So if you hire one worker, you pay her $10. If you hire 2 workers, you pay them $20 because you need to pay each of them $1, right? So 6 workers, $60. It changes. It's variable with when you change the number of labor, okay? And column 6 is simply adding column 4 item and column 5 item up. So the total cost is, right, in the sum of a variable cost and a fixed cost. So let's put variable cost. Makes sense now? So for the case of one worker, we need to spend $30 for the fixed cost. We spend $10 to hire one worker. The total cost is $40. And say when we are hiring two of them, right, we pay $20 for the wages, $30 for the fixed cost, $50 in total. So the same for all the rows. That's how we actually derive this table. And in the problem set, right, I would remove some of those numbers. So you just follow how we calculate, right, each cell to fill in the blanks. All right, so from the table, right, on the previous page, if we denote, we depict, right, each point, right, say when there's one worker being hired, we have 50 cookies being produced in that sense. And if we have 2 workers, we can produce 90 cookies, right? And 3, 4, 5, 6, we can find those points, coordinates, right, on a graph if we plot number of workers along one axis and the output along another axis. So that is exactly what we called a production function. It shows for one, right, for each additional unit of input, so in this case workers, labors of course is one of the inputs to produce goods, right, cookies. 1 worker we have 50, 2 workers 90, if you still remember the numbers, 3 workers we have 120 and then more, just plotting them there. And by just eyeballing, you can easily tell that the slope of this production function, which we derive by connecting each point that we got from this table, right? So it's getting flatter and flatter if we move from 0 to more and more workers. So that gives you a sense. The production process is getting less and less efficient when we're increasing the number of workers, right? And even at some point, if we imagine this to be flat, it's like hiring more workers is not going to give you more output. That actually reminds me of a video clip I watched like a couple of days before. So she was an former Meta employee, and she believed she got paid like $190K for a year to hire no one, because she was hired as a recruiter and she did nothing basically in that year. So as you could see, right, when certain organization is kind of oversizing, then additional worker will probably be not very productive or not productive at all. So that makes sense when they are trying to lay off more people, right? Because obviously there are some problems with their HR or the organization of the company itself. Anyways, so the main takeaway here is we believe, right, additional unit of input will not always be that beneficial or not equally beneficial. It's that increase in output brought, right, related to additional unit of input tend to shrink, right? And that explains why we're seeing a flatter and flatter production function, because the more inputs, the less efficient the production process will be. And we call this a diminishing marginal product. So this is a very powerful concept, right? You could learn from the microeconomics. And remember, what is marginal product, MP? That is simply column 3. That's the difference between like today's output and not today. That is the difference between output when we hire 1 worker comparing to hire 0 workers, and the difference between, say, when we hire 3 compared to when we have 2. So this MP cannot usually be constant, right? It has to change. It's totally determined by column 1 and 2. It's totally determined by how much, right, that additional worker could help, right, the production. How much increase in output the additional worker could bring to the company, the factory. So moving on, we're going to talk about another curve, the total cost curve. So remember that the 2 axes, right, of a total cost curve, one is the quantity of production or output, which is basically the column 2 in here. And the other one is the total cost. so it's column 6, right? So a production function plots column 2 against column 1, while a total cost function plot column 6 against column 2. So even though those two graphs, right, contain information from the one same table, but we're actually studying the relationship between different variables, right, using different graphs or curves. All right, zooming back. So even though this table only have information up till like this part, we see an increasing, right, cost along with an increasing output. But we need more information to plot further. The textbook actually gives us, right, a typical shape or shape of a typical total cost curve. So at the beginning is kind of increasing, not in a crazy way, right? But then we see a very steep climb, right? And that is due to, again, a diminishing marginal product. So the very simple concept rationale behind it is production tend to be less and less efficient when we are putting too much resources, right, into the production itself. So it doesn't mean like every factory is doomed. It's just we might need to keep, say, improving, renovating the facilities, machines, or the production process itself, but we still cannot, right, violate, right, the nature that production will be less and less efficient, and we will see a diminishing marginal product when we increase the number of input. So on this graph, I also plot a total fixed cost, which is $30. It doesn't change, right? No matter how much output you produce, no matter how many labors you put in, the total fixed cost will be a horizontal line, like this red line here. And I also plot a total variable cost. So if you recall, total fixed cost, TFC and TVC, they are basically the column 4 and 5 from this table, right? So we have these two curves. And if you add the number at each output level, then we would have, right, the quantity of the total cost curve, right? Makes sense. So basically, total cost curve is adding 30, right, the total fixed cost, onto the total variable cost. So it's like shifting up, straight up, right? That's the relationship between the total cost curves family, right? So TC, total cost, equals TVC plus TFC. This is what we just covered. And what is more relevant to production decisions instead of the total cost would be the average costs families. So here we introduce more of measures of costs, right? First, we define an average total cost, that is TC over output, total cost over the total quantity of production. And average fixed cost, AFC, would be, you can write it here, AFC equals TFC divided by output quantity. So TFC divided by quantity. And AVC, just copy it here and change AVC equals TVC divided by Q. So very simple like definition here and calculation if needed. So next, we need to define a marginal cost, and it's just, right, a marginal variable. So it's again measuring the increase in certain variable that is caused by an increase from additional unit of something else. So put it in the context. MC, marginal cost, is defined as, right, how much the total cost would be increased when we are adding one extra unit of output. So the change in total cost divided by the change in output. That's the marginal cost. And if we try to plot all those curves onto a same lens, we would have some typical shapes of each curve. For example, the AFC, we would see it decrease all the way, but steeper at beginning and flatter in the end. That is because you are dividing a fixed number from a smaller, super small number to a larger and larger number. You would get a curve like this. And put it in reality, consider if you're starting a new business, right, and you purchase all the machines you need, you invest in rent, then at the beginning of your business, the fixed cost will be super high. But if your business went well, then you kind of soon get repaid, right? And you wouldn't care how much fixed input, how much fixed costs you already spent. And a typical shape of a marginal cost curve would be it decreases at the beginning for the small amounts of production output, and then it just keeps rising no matter how much you produce. And that is again due to the diminishing marginal product. It's due to the inefficiency occurred with higher and higher level of output. And here you might ask if the diminishing marginal product is always in play, right? Of course, we'll see a rising MC curve, but y is downward sloping at the beginning. So the economic explanation for that is what we actually learned from the trade chapter, is the specialization. So consider, right, when you are having a very small business and you have only maybe 1 or 2 or 3 people running the whole business. So they basically have to cover everything, right? But if your firm business is undersized, then hiring additional worker, producing more, will allow for specialization, right? And that brings efficiency into the production process, so that fight against the drive of diminishing marginal product that inefficiency drives. And therefore, we would have some downward period along the MC curve. But sometimes this could be really short, right? You most of the time observe a upward sloping, a growing marginal cost curve. And consider the shape of a average total cost and average variable cost curves. They're both U-shape. And they both intersect with the marginal cost curve at their lowest point. If we try to interpret this relationship on the graph, recall that marginal cost, MC, right, is how much cost one additional output would incur, and what is ATC, average total cost. It is, right, considering every unit of production bears, right, evenly of the total cost, then what is the total cost per unit? And so the average total cost curve, ATC, and the MC curve, they intersect around 7 units of output, right? And consider, so before 7 units, right, when this firm is producing that is lower than 7, the relationship between MC and ATC curve is ATC is higher than MC, right? Whether it's 6, 5, 4, 3, 2, or what unit, average total cost is always higher than the marginal cost. That means, right, before 7 units of production, producing 1 additional unit will cost less than what your current cost per unit is, which means go for additional unit, right? Because it's efficient, it's a good deal. And after 7 units, now the additional cost, right, the cost of 1 additional unit would be higher than your current unit cost, which is the ATC. So MC, when MC is higher than ATC, is not a good deal anymore. And this will drive the ATC up as well, because the more you produce, the higher the cost is. And similarly, that explains why the AVC is a U-shaped and it intersects with MC at the lowest point. So the last concept I want to go over in chapter 14 is the economies of scale, and also the diseconomies of scale and the constant returns to scale. So before that, we need to first derive a long-term average total cost curve from the short-term average total cost curve. So now that we agree, right, average total cost curve will always look U-shaped, so we can draw them like those blue parabolas, right, on this graph. And in the long run means we're looking at a longer time horizon. So instead of producing for 1 day, for 1 week, in the long run, we can just keep producing, right? We can add extra labor hours. So in the long run, we consider the output we can keep the output growing. So we move from 0 to, imagine, like infinity in the long run, right? So we move from left to the right. That's the general direction. And now let's consider what happens when we keep increasing the amount of output. What happened to the average total cost? So in the short run, consider we are looking at a small factory, right, with less workers, small amount of workers, and we only say started last year, so we don't have that much high level of output yet. So we're producing along this blue parabola. This is our short run ATC. And now that we're kind of established our stand in the industry, right? We would like to produce more. Okay? We build some loyalty from the customers, and in the long run, of course, we want to expand. We want to produce more. So suppose this is my ATC curve now, right? Do I want to put it here, right? That means, say if I just put a curve here. So it means if I produce more, instead of going along this blue curve parabola, I want to go along this blue cost curve, ATC curve. No, I don't, because the higher the curve is, that means higher cost I'm facing. So I want to, instead of bring it up, right, up, I want to bring it down. I want to bring it as low as possible, right? So in the short run, in the long run, I want to lower my cost while moving to the right, while producing more. So I hope, right, to bring those curves down. So let's say I put one here, and in the long run, of course, I can hire more workers. I can buy new machines, right? So that means I can change my cost curve. So I can draw more and more cost curves. Say later on, I want to draw another one that's to the right of the old ones, but also lower than the old ones. So that's what I want. And if I could, I want to draw more and more, lower and lower, but I couldn't, because at some point the diminishing, right, marginal product will kick in. I can't put it here. Instead, I have to put it here. Okay, this is how the ATC curve behave in the long run. It's flatter, it's still U-shaped. Because even though we do want a downward slope, long run average cost curve, but we couldn't. At some point, it has to stay flat. That is because all the efforts in the long run that we try to lower the cost, or all the efforts we try to fight against the inefficiency in production process, and we try to find the diminishing marginal product, right? So we have this flat area. But when we are big enough, like Meta, we will see, right, inefficiency. We will see. Okay, so that's all for chapter 14. I also attached some summary tables for you to study. And please make sure to finish your problem set and a discussion board. Again, if you are still interested in try more attempts of your midterm, or you want to work on your part 1 of your project, we can still, I extend the deadlines to March 31st. We can still get that done first, right? So thank you.